Focus. Ideate. Innovate. Enable.
Hello and welcome to this investor camp from Kolkata, the city of joy. Used to be capital of India at one point, of course. A very hustling and bustling city full of energy. And I feel privileged to be here and doing this investor camp. Let's not waste any time then, and let's straight away go to our first guest, Ashwini Gujral, talking about the importance of market technicals.
I think demonetization has led to a standstill in sales. So possibly the market came down because of that. But I think that's an opportunity, because are the sales going to come down forever? No. Once the money supply stabilizes, probably people will again start spending. So if I were one of you, I will ask 2 or 3 basic questions. Is it still a bull market? Yes. You are down 10%? Yes. If you keep buying all 10% corrections, will you make money finally? I think yes. Several, blue chip consumption stocks are coming down, like Maruti, Asian Paints. So build positions out there, and once life gets back to normal, these stocks will again rise. Now what we are going to discuss today is stock selection, because often the problem why people don't make money is because they tend to select the wrong stocks. What is the reason for 80% losses in the market? Choosing the wrong stock. What are wrong stocks? JP Associates, okay? All kinds of PSU banks. What is the structure of stock moves or index moves or any freely traded commodity stock or index moves? There is a phase called accumulation. Accumulation is the phase where the big commercials buy. Commercials as in mutual funds, pension funds, insurance companies. Once they've done their buying, the market tends to rise. Then there is a rally mode where retail and smaller participants come in. After that, the market gets fairly overvalued, and that is where the commercials, they start to distribute their stock and start to book profits as there is good news all over. And that is where most retail tends to come in. And once the distribution is over, markets tend to get back into a decline and again go through that process of up and down. The first issue to buy a stock is that it should be in stage 2. If you buy a stock which is in stage 1 or in stage 3, you will get into a rut because the stock would be moving sideways. So first try to see on a weekly chart, on a daily chart, is the stock really in that phase where it's beginning to rally and make fresh highs at regular intervals. So always focus on things which have shown multi-year long-term trends, and all you have to do is just keep looking at the averages on all time frames. On a Saturday, Sunday, I would look at the weekly 20 and 50. Once a month, I would look at monthly 20 and 50. Every day, I look at daily 20 and 50. Till, all trends are, focusing on going up. That's what you look at. Finally, like with everything else, it's whatever car you buy, always look for the brakes. So always use stops. Now people like to ask me where to put stops, because stops get hit. Put stops at the reason, below the reason of your buying. So if I am buying something which has a parallel moving average, I would be buying the day the correction ends and you get a large bar towards the upside. That means some people other than me are also planning to buy. So below the low of that bar, you can easily have your stop, and if you've identified the stock correctly, if the correction is really over, you have a 1 bar risk and you can probably make 10 bars out of it. So that is how the best stops are placed. It should not violate your reason of buying. Markets don't owe anybody anything, and it's a game of skill. The more skilled you are, the better off you would be. So always, try to look at it from above instead of trying to look at it as a participant. When it's a bad day, all sentiment is against you, always try to buy. If you see several bad days when there are 300-point falls, often they are the best buying opportunities. Thanks for coming. You've been a good audience.
That's Market Technicals. Let's take our first break. When we are back, we'll discuss market fundamentals and also the macros. Welcome back. You're watching the Investor Camp from the city of Joy, Kolkata. Before the break, you heard from Ashwini Gujral. Now it's time for some market fundamentals with Deepan Mehta.
Thank you, Kolkata. Thank you. It's really an honor to address all of you over here. And I really have very fond memories of Kolkata because you all have some exciting companies like Vesuvius and Exide Industries on which I have made a lot of money as an investor. What we're going to talk about today is smart investing, which is basically a sort of set of principles or techniques or processes which you can follow to build a high performing portfolio. So now the first principle is diversification. So having a good strong look at the sector allocation in your portfolio is one of the first principles of smart investing. You have to have a well diversified portfolio. And if you were to ask me what percentages should be in which industries, in the Sensex, banks and financial services are 22%, software is 16%, so on and so forth. So this is like a good indicator. You could decide to be overweight in some of the sectors which are performing, and we all know the performing sectors, like we know banks are doing well, we know automobile shares are doing well, we know that metals have started doing well lately, but we know that, for example, software, information technology is doing badly, so you can be a little underweight over there. Broadly, if you have a nice, well-diversified portfolio into several sectors, then you will do exceedingly well over a long period of time. The next stage is stock selection. I don't expect a lot of you to be great stock pickers. Many times you take advice of experts like us, or you watch on the channel. The media also gives recommendations. Your stockbroker may give recommendations. But here are a few questions that you can ask to make sure that you're avoiding any mistakes. Like the past track record. A company doing well for past 4, 5, 10 years may continue to do well for the next 5, 10, 15 years or so. Another aspect is, should I be a safe investor or should I be an aggressive investor? This is the question, which many investment advisors also ask. What is the level of safety I should have in my investments? Not just stocks. What is important is how much are you able to generate every month or every year to invest in stocks? Because if you have a profile or if you have a steady cash flow coming in, and if that cash flow is available for you to invest in the stock markets, then you can be aggressive. Because if you make a mistake, the next time you invest, you can get it right. And the next time you invest, you can further get it right. So you have the power to average your investment into the equity market. Not individual stocks, but the equity market as a whole. Lastly, smart investing is not just good stock picking. It is managing a portfolio. It's managing the processes. If you follow the broad principles, what you will have is a nice, healthy, performing collection of stocks which can do extremely well in the long run. And that requires financial discipline. Alright? So unless you have the discipline, the temperament to remain invested for the long period of time, only then you should look at equities, and only then you should look at investing in stocks for the long term. Thank you.
Well, that's market technicals and market fundamentals, but macros play an important part too. Here's Garima Kapoor, the economist at Yes Bank, with her thoughts.
Indeed, these are really interesting times to be in India, and especially after the government's last 2 months of performance, one bang after the other. We had a GST, just as we were coming to terms with the fact that midterm potential is improved with the passage of GST, which we were awaiting for so long. Government has now taken a bold move through demonetization. I have a small presentation that will take you through what we believe is likely to be the outlook in next 6 to 10 months and over long term. Markets so far, particularly in India, we have had a decent performance if we compare globally. Nifty has given a decent performance. But overall, if I look at what has been happening last 1 year, it has been a year of a lot of concerns for the global economy. naturally the biggest concern for the global economy is growth. Significant number of countries, particularly in the Eurozone, emerging market space, especially China and the countries which are dependent on Chinese economy in terms of exports, and to large extent certain other emerging markets in Latin America have not been performing well. Now, what is the concern? This year, IMF has said that global growth will remain subdued, 3.1%. Last year also you did 3.1%, so this year you're seeing no incremental improvement in growth. Why then markets are not performing as badly as you would have expected with such subdued growth? The biggest support factor for market this year has been central banks. Eurozone, Japan, Switzerland. Three major economies are now running on the negative interest rate policy. And expectations are that with the kind of deflationary concerns these economies face and with the concerns on growth, the near-term outlook also says that they will remain on an easing path. We often like to talk about why macros are important for markets. Clearly, a high growth and a low inflation environment is much more beneficial for equity markets rather than a high growth and high inflation environment. A low growth and a low inflation environment is not as good as a high growth and low inflation environment, clearly suggesting macros are the guiding principle, or your fundamentals of the economy are the guiding principle even for investments. Again, everything is hunky-dory, but don't forget the risks. There are some. How Brexit plays out over next 1 year remains a key risk. Of course, India has adapted well to that event. We remain very fundamentally strong, but we can't completely rule out geopolitical risks, especially because a lot of it is happening with regards to major oil-producing nations. We do not know how the decisions between OPEC may pan out. 3, increase in rates by Fed. We expect one rate hike in December, followed by at least another in 2017. Now this is going to be rate hike after nearly 1 year. Last rate hike by Fed was in 2015 December. China is slowing down. China has its own problems in terms of trying to adapt to growth. Of course, domestically, government has come up with a lot of reforms, but all these reforms are going to be mid-term in nature. No major impact expected in short term. Implementation remains the key. And of course, despite everything improving on the consumption front, your investment appetite, especially in the private sector, continues to remain weak. So we need to release are likely to be some bit of headwinds that India might continue to face in the near term. I think with that, I'll conclude my presentation. Thank you very much.
Okay, we'll take a break on that note. Once we come back, the fun part of Investor Camp, the audience Q&A. Welcome back. You're watching Investor Camp. Just a reminder that yes, we are on TV, but we are also on social media. We have our very own app called the Investor Camp. You can download it from the Google Play Store and of course get information on all the camps from various cities. Well, now let's move on and have the fun part of Investor Camp. Our audience having a Q&A with all our guests.
My question to Mr. Dipen, what is the outlook for pharma industry and particular stocks, if any, you recommend?
Well, I think pharma industry is going through some turmoil. No doubt about that. There's pricing pressure in US, which is the biggest threat. I think largely US FDA issues are getting resolved company by company, but the bigger threat is prices in the key market are under a lot of pressure because of intense competition and consolidation on the buyer side. But the underlying long-term fundamentals of the industry are very, very fantastic. It's not just US markets. I think India is going to be the largest supplier of pharmaceutical products all over the globe. And basically, pharma is such an industry that irrespective of the economic slowdown, the spending on pharmaceutical products globally keeps on rising because of an aging population. So you have to be a long-term investor in the pharmaceutical industry. Well, I think with usual disclosure that we and our clients are invested, I think we do like stocks like Aurobindo Pharma, Strides Arcolab for 2. Third would be Cadila Healthcare. Fourth would be Glenmark Pharma. And fifth would be Torrent Pharma. So I've given you a basket of 5.
Okay, That's 5 stocks. Let's move on.
If I just come to direct tax, as the lady said, the amount of money which is coming into the system and out of the system, so with so much of money coming in, won't our market dependence on FDI reduce with so much of money coming into mutual funds?
Okay, that's interesting.
The first thing to understand here is that banks are starved of funds. So any capital that comes into them, if the government really sources it back to them as capital, will be one positive. And two, we really are seeing a sea of change in terms of how fundamentally we are doing business. So the FDI which is coming to India is more of a pull factor because the Indian macros are very stable. So irrespective of what happens domestically in terms of impact of monetization, we will continue to remain an attractive destination. Of course, any amount of capital that enters India, because we're fairly capital starved, is always welcome.
My question to Mr. Mehta and Mr. Gujral is that since lot of liquidity coming to banks, in the coming days, how fundamentally banks are going to perform? We have seen all NPA theories, etc., this and that. As SBI result was very bad, Q2 result was bad. Now what? BOB was very good. And question number 2 is regarding metal sector.
Okay, got the question. So
yeah.
Banks and metals.
Banks and metals.
Okay, Deepan, actually we have one question from app user as well, Manish Verma. We were talking about the app. He's also wanting to know the outlook for banking sector and how you should go about it.
Well, I think everybody should have a strategy for banks. I mean, have a look at your portfolio. You should be having at least 25% of your portfolio into banks. Okay, it is the sector which is going to be doing exceedingly well over the next 3 to 5 years or so. There are many positives, fundamental trends benefiting this sector. And this latest demonetization plan is a further kicker, a further trigger for the banking sector. So what banks do basically is they borrow and they lend. Their cost of borrowing is coming down because interest rates are coming down. And at the same time, they are able to maintain the net interest margin, which is the highest in the world at present in India. A lot of work has been done on the non-performing side. So the cost coming out from bad debts or non-performing assets has peaked out and will gradually come lower and lower. And then we have a whole host of average Indians, even the rural economy coming more and more into the banking space. So you have many positive trends, many positive triggers happening for the banking sector and the NBFCs. And these are long-term, secular, structural changes taking place in the banking sector. And if you are in these stocks for the next 4, 5, 10 years or so, you will see fabulous wealth getting created. The next question is which stocks to invest in within the banking sector. And the answer to that also is very clear. You have to go with the private sector banks. They will gain phenomenal market share over the next 5, 10 years or so. And PSU banks will be a smaller and smaller portion of the banking industry. At present, most of the private sector banks are in a secular growth mode. So you have to go for the private sector banks, you have to go for the NBFCs. They have a better plan, they have a better management, more aggressive style of garnering higher and higher business which is available. And lastly, there are many avenues also opening up. There are financial services, like most of the banks have gone into insurance, they've gone into stockbroking, investment banking, consumer lending. So many ancillary activities are also doing well for the banks and financial services industry.
Okay, so banks and private sector banks. Ashwini, the other question was on metals. I remember you were telling us on channel 3 or 4 days back that this metal rally is here to stay.
See, definitely stocks which are doubling and going up many times over, something fundamentally is changing. Now the good news will probably come 6 months from now when these stocks would have tripled. But definitely, chartically, if you look at the action, they are the ones which correct the least. They are the ones which go up the most. Tata Steel, which has a lot of problems, went up 8-10% the other day. Why? Because something is changing fundamentally behind the scenes, and chances are that all of metal stocks could outperform along with banking. My view on banking is that if somebody wanted to recapitalize the banks, it's happening free of cost. So PSU banks didn't have money to lend. Now they have money to lend. So maybe they outperform in the short run. But in the long term, Deepan is right that private sector banks will probably do much better.
That's all from Kolkata for this edition of Investor Camp. We'll be back next time with New City. Thanks a lot for watching.
Focus. Ideate. Innovate. Enable.